If you're a business owner and you want life insurance or you pay for life insurance right now, you should be taking a tax deduction for it. That's not financial advice, that is just my opinion. And I'm going to show you how to do that by using what's called the non qualified pension plan. Now, you've probably heard of 401ks, cash balance, non qualified deferred comp plans. The main problem with all of these plans is that they create long term taxable income, whereas this plan, it creates long-term tax-free income, or I should say tax-advantaged income. The advantage being you don't have to pay tax if you take it via policy loans, which I'm going to talk about in this video. So this is a strategy that wealthy people, corporate insiders, business owners, they've been using these plans for decades. It actually predates the 401ks, the cash balance, etc., and it's called the non-qualified pension plan. It's been one of the smartest ways for business owners and executives to build private pensions for the past 70 plus years. Regardless of how you feel about life insurance, the top 1% do use these plans, and they've used them for centuries and they will continue to use them. So, key points of this: it's been in the tax code since 1953. It's used by business owners and executives who are looking to put away large sums of money for retirement, especially tax efficiently. It does not have the same contribution limits that traditional plans have. It does not have the early withdrawal penalty like traditional plans have. And additionally, oops, got to click on that right there. Sorry about that. And it can double as a deductible buy-sell agreement, golden handcuffs, buyout arrangements, capital funding, and many, many more options for you. Okay, so these plans are funded in 5 equal payments over 5 years, and it's like a pension you actually control. This is just an off-the-shelf IUL, and it is purchased as an employee benefit. And that means that, let me scroll down right there. And that means that 100% of the contributions are deductible to your business. 50%, roughly 50%, there's a formula we have to follow, are going to be the premiums that go in are going to be taxed like a Roth, and 50% of the premiums are going to be tax exempt, meaning never taxed. Now, let's compare that to an executive bonus plan, which is also a life insurance based plan. An executive bonus plan, 100% of the bonus that is going to fund the premium payment is going to be taxable income to you. With this plan, we're 50% more efficient because only 50% of the taxes are going to be taxable income. The other 50% we're writing off, we're deducting the cost of the life insurance. That money is never taxed, and then it's going to grow tax-free and it's going to withdraw tax-free. 100% of the income generated from these plans is going to be tax-free when it's taken via policy loans, and 100% of the balance of the plan when you pass away is going to be tax-free to your beneficiaries, to your kids, to your spouse, etc. So let's talk about how the plan earns interest. Now, understand, guys, I have a full video that goes over policy loans and will teach you the in-depth on how policy loans work, but that's what I'm talking about here. And before you understand how policy loans work, you got to understand how the plan earns interest. This is a high-level overview. I do have a video that explains this that you can watch on my channel. I'll link it below. So the contributions, the premiums, right, are paid into the life insurance policy. The insurance company is going to take out the fees. They're going to take out the expenses, which that will be less over the long term, over the life. This is a permanent life insurance policy, right? Those are going to be less than a 401k, a cash balance, a SEP IRA, etc. But the remaining premium is going to go into your cash value account. Now, your cash value account, it's going to mirror the growth of an index, for example, the S&P 500. Now, the standard index account has a floor of 0 and maybe a cap of 10. That's just the standard range. Could be a little bit more on the cap, could be a little bit less on the cap, depending on the company that you go with. What that means is that you earn interest up to the cap. So if we have a really good year like 2024, you're going to earn it where the market did what, 25%. You're going to earn interest up to the caps. You get the 10 and then they take the rest. If we have a really bad year like 2008, for example, and the market's down roughly 40%, you're going to get a 0 while everyone else lost 40%. So very good safe money alternative here. And then when you want to generate income, you take a policy loan. Now, the reason you take a policy loan is because you want to retain the ability to earn interest. Your money is inside of your cash value account, earning interest, compounding over and over and over and over. You go out and you spend someone else's money, aka the insurance company, tax-free, mind you. And then the death benefit, which is what all those fees went to, is what pays back all of those policy loans. Now, I'm a firm believer that dollar for dollar, life insurance, specifically the non-qualified pension plan, will outperform 401ks, IRAs, SEP IRAs, cash balance, etc., on a dollar to dollar basis. So if we take the same two plans and we do the same exact funding, this plan, I believe, due to policy loans and the ability to earn interest, compound interest, is why we can beat those plans. But understand as well, I'm not trying to compare this to your, Tesla stock or your Nvidia or Bitcoin. We're not trying to compare it to that. But I would compare this to a bond fund all day long, because bonds have performed terribly over the past 10 years or so, over the past 20, 30 years even. In these plans, we can nearly match the growth of the S&P 500 with a fraction of the risk, because the risk is a 0% floor or 0% rate of return. So let's continue with the video. Let me walk you through an example and then we'll get you out of here. So 45-year-old business owner needs to put away six figures per year for retirement. He's going to do $200,000 a year, and this is a real case, by the way. $200,000 a year over 5 years. It created $262,000 a year of tax-free income, or is projected, right? This is not guaranteed, projected to create $262,000 a year of tax-free retirement income. So I want you to think about this for a second. $1 million over 5 years at a 40% tax obligation. He paid $199,000 in total taxes paid. $500,000 roughly is never taxed, tax exempt. So it's more efficient than a Roth, it's less restrictive than a SEP, and it's cheaper to administer than a cash balance plan. The result being long-term tax-free income and tax-free wealth transfer to your beneficiaries. So that is the non-qualified pension plan. If you are a business owner, there is no reason you should not be deducting your life insurance unless you are financing it, which is a completely different conversation. We're using a couple different options as well. But you should not just be purchasing an IUL and not getting any leverage on it. Leverage being tax savings or financing. So I talk about both those things on my channel here. Specifically, I talk about taxes. I also teach how to leverage life insurance policies in order to generate 6, maybe 7 figures of tax-free retirement income. If you want to learn more about that, subscribe to my channel. And if you need any help on tax mitigation, we're approaching the end of the year here. It's November 12th as of today. If you need any help with tax mitigation for 2025, or you want to recapture some of 24, 23, or 22, reach out, send me a message, find my links below, and we'll see how we can help you. All right, take care. Bye.